From boom to bust, the shocking truth about bank failures and their devastating impact on economies. The domino effect of bank failures sends shockwaves through markets, leaving investors reeling. But is there a silver lining in the midst of the chaos? Do bank failures always result in recessions? Find out as we delve into the heart-stopping truth behind bank failures and their far-reaching consequences. In a shocking turn of events, the recent bank failures have exposed a sinister trend that could send shockwaves throughout the financial world. The similarities between these failures are chilling, as they all share a common thread: serving niche markets rather than everyday consumers. One such bank is Silicon Valley Bank, the financial backbone of the global center of innovation. With huge account sizes, it catered exclusively to businesses that make Silicon Valley what it is today. But what is truly concerning is the fact that some of its largest depositors had accounts worth tens of millions, even hundreds of millions of dollars. But Silicon Valley Bank is not alone in this troubling trend. Signature banks, Silvergate Bank, and other financial institutions catering to the wealthy and powerful are also teetering on the edge of collapse. And let's not forget Credit Suisse, which has been shaken to its core by the market panic. The average bank account size in the U.S. has skyrocketed to over $41,600 since 2019, with the pandemic only exacerbating this trend. But as these niche banks continue to attract large companies and wealthy individuals, one can only wonder, is the banking industry becoming too big to fail or too big to save? The stakes are high as the government and the Fed face the possibility of bank failures that could cripple the economy once again. History has taught us that catastrophic consequences of such failures. Just look at the Great Depression. And while the FDIC offers some protection for low-income depositors with a guarantee of up to $250,000, it's not enough for most account holders. This creates the risk of bank runs, where people scramble to withdraw their money before it's too late. But there's a solution that could alleviate this risk: unlimited coverage for all bank accounts, regardless of the amount. It sounds like a dream come true, but is it too good to be true? Financial regulation professor Jean Edward Collier warns that unlimited coverage could lead to even more panic among depositors, ultimately leading to banking panics that could shake the entire system. And yet, the FDIC, Treasury, and Federal Reserve seem determined to pursue this path, offering a bailout that would be funded by taxpayers. But there's a catch. The cost would be passed along to bank customers in forms of higher fees, lower interest rates, and other indirect charges. The people who had entrusted their hard-earned money to these banks that had no involvement in their operations, were on the edge of their seats, waiting for news of their deposits. But then, like a bolt from the blue, it happened. The people got their money back. It was a glimmer of hope in the darkness, a signal that this was a safe way to keep their money and make a profit. The banks had sent a powerful message. They were here to stay, and they meant business. But not everyone was convinced. Some raised concerns about moral hazards in the banking system. Was this really the example that should be set? Would it encourage reckless behavior in the future? The stakes were high and the tension was palpable. As the night wore on, the Silicon Valley Bank, once a beacon of stability, found itself in dire straits. Despite having enough assets to cover its deposits, it was forced to scramble for a solution at the worst possible time. The pressure was mounting and the clock was ticking. In a desperate bid to salvage the situation, the bank turned to the Federal Reserve Bank, the lender of last resort. But the Fed had issued a warning. Emergency loans could be a double-edged sword. If a bank run happened too quickly, it could be a futile attempt to save the sinking ship. Credit Suisse also found itself caught in a whirlwind of panic and uncertainty. Withdrawal pressure was mounting, and the fears of bank failures were spreading like a wildfire. The stability of a banking system was being questioned, and the loss of confidence was palpable. But while the rest of the world trembled with fear, a group of economists remained unperturbed. They dismissed the recent bank failures as nothing more than a minor blip on the radar, a mere hiccup in the grand scheme of things. But the truth was far more sinister than they realized. For in a strange new world, banks were no longer the pillars of the economy they once were. People had found other places to store their money, and the flow of cash had moved beyond the confines of traditional banking system. The once mighty institution were now relegated to the sidelines, struggling to find their place in a world that had left them behind. But there was still hope. Banks had an important role to play in the economy, and there were those who believed they could be saved. By lending money to individuals and businesses, they could add value to the economy and provide employment. They could even act as deposit takers and loan makers, creating a money multiplier effect that would boost the economy even further. But it was a fragile hope, for the banking systems were flawed. They didn't work the way they were supposed to, and they didn't need deposits to create money. Silicon Valley Bank was a perfect example of this, with most of its assets tied up in low-yielding government treasury bonds. And yet, there was still more to come, for the Feds had just released a paper that would shake the very foundations of the economy. It was a paper that would teach economic teachers about the importance of maturity transformation, and it would change everything. The Federal Reserve Bank is the guardian of the American financial system, tasked with ensuring that every single individual is protected in case of a banking crisis. Silicon Valley Bank, with all of its assets, seemed to have it all together, but fate had something else in store for them. At the worst possible moment, the bank was hit with a problem it couldn't solve. Panic began to spread as the customers realized that they might not be able to get their money out on time. In a situation like this, the Fed was supposed to step in, acting as a savior of last resort, providing short-term loans to distressed banks. But with the possibility of a bank run looming large, the Fed issued a chilling warning. Emergency loans could be futile if the panic was to spiral out of control. Will Silicon Valley Bank survive this ordeal, or will it be consumed by the frenzy of fear and uncertainty? Panicked investors clamored for their money, demanding withdrawals in droves, threatening the very existence of the once revered financial institution. As fear gripped the banking system, confidence evaporated like a mirage in the desert. The stability of the global economy hung in the balance, teetering on the brink of disaster. The threat of a domino effect with other banks toppling like a house of cards loomed ominously. Economists, usually the voice of reason, were divided. While some tried to assuage the rising panic, others couldn't hide their unease. Was this the beginning of a catastrophic chain reaction that would reverberate across the world, plunging economies into turmoil? The role of banks in the economy, once thought to be a sacrosanct, was now under scrutiny. Were they still the pillars of stability they once were, or had their significance diminished in the modern world? Money, the lifeblood of economies, seemed to be slipping through their fingers, flowing elsewhere, threatening to create a ripple effect of unemployment and economic instability. In a world where money rules everything, banks hold power to create or destroy the economy. They lend money to individuals and businesses, making dreams come true and providing employment opportunities. But what if the very system that we trust is flawed? It all starts with the concept of money multiplier, the idea that a single deposit can be loaned out to create a chain reaction of economic activity. But what if that concept is just an illusion? What if banks don't need deposits at all and can create money out of thin air? Enter Silicon Valley Bank, a notorious example of this very phenomenon. With most of its assets tied up in low-yielding government bonds, it has hardly any customers to speak of. Yet it continues to thrive, creating money in accounts without real banking. As the world stands on the brink of economic collapse, the Federal Reserve has released a paper that could change everything. It aims to teach economic teachers at schools and universities about the importance of maturity transformation, a term that could hold the key to saving the economy from certain doom. Will this paper be enough to turn the tide against the banks, or will the power of money continue to rule over us all? Only time will tell in this thrilling saga of finance and economics. The question of whether bank failures always result in recession is a complex one. While there have been instances in history where bank failures have led to severe economic downturns, such as the Great Depression, there have also been cases where individual bank failures have not had a significant impact on the wider economy. It's important to understand the underlying causes of bank failures and the context in which they occur to assess their potential impact on the economy. If you want to learn more about the fascinating world of finance and economics, be sure to subscribe to our channel and hit the notification bell so you don't miss any of our future videos. And as always, feel free to leave comments down below with any questions or suggestions for future topics you'd like us to cover. Thanks for watching.